I saw many different views on markets, and I certainly look at markets, but then I really became more interested in precious metals. But I still look constantly at the markets, not just because it's a habit, but because what's happening in the markets does have an impact on commodities as well, which I'm now more focused on. Certainly precious metals, definitely overvaluation. I think even if you're bullish in this market, and there are not many bulls that I know of between coffees, off hours, unofficial conversations, you have to be bullish if you work for a bank. You have to be bullish typically if you're a portfolio manager with limited partners and investors. You have to always be, optimistic in some way, but it's hard to do when this market is so openly overvalued by pretty much every metric. I mean, right now the NASDAQ is trading at 49 times earning. That's not where the Nikkei was in 89, but it's nearly at all-time highs in terms of just grotesque overvaluation. I think it's worth a few minutes on the markets because many Europeans and obviously many Americans still have a great deal of their optimism and hope that the markets will continue to save them and beat inflation and protect them in their 401ks or retirement portfolios, et cetera, because it has been such a positive market despite the economic disconnect on the Main Street. And I'm not here to say the markets are doomed this month or this year. No one can time a market correction, crash, implosion, mean reversion, but we can measure market risk. We can identify a market bubble. And I'm not alone in saying that we are in a bubble. I don't think that's a huge stretch. It's probably the most optimistic market I've ever seen. But a normal market correction, a normal mean reversion to get back to fair valuation would mean a 50 to 75% fall in the current S&P, which would be devastating to many folks who are planning to retire or live on their portfolio in the market. And rather than just say that as a gold bug cynic or a doom and gloomer, it's important. I come from the risk asset space. I talk to a lot of portfolio managers who are still trading stocks and bonds primarily. So it's not just me as a gold bug saying the market's overvalued and dangerous. I mean, this is something that, Gundlach out of the bond market would agree with. I think Ray Dalio would agree with it. He ran one of the biggest hedge funds in the world, Bridgewater, Druckenmuller, Jeremy Grantham, who's been retired now for many years, who ran GMO. All of these much smarter veterans of the stock market than I ever was have very similar opinions to me. And I think we have to look at this with open and realistic eyes. There are some who argue that even with inflation, even with these risks on the Main Street economy in Europe and in the US in particular, that the markets can still continue to rise north based on the powerful technology, the AI meme. I've seen that story before during the great financial crisis leading up to that mortgages could never fail. They're the safest asset. I saw that meme during the dot-com bubble in the late 90s, early 2000. That the Internet of Things was going to change everything, that was going to save us, that this time was different. We're seeing that meme right now with AI, that AI is going to make the difference and prevent these markets from ever having any kind of uh-oh moment because there's such a radical new and sexy technology, and these primary companies that are all investing significant amounts of money into AI will keep this market up. That's a positive sign, you could say. And there's also the argument that the Fed will always have the back of this market, that the market is basically too big to fail. If we saw too severe a dip, that the Fed would create more liquidity and support the markets directly or indirectly in some way. And so there's a whole generation of investors right now who haven't never really experienced a major uh-oh moment in the S&P or in the markets that wasn't immediately corrected. In other words, every dip was a buy. And I think that creates a moral hazard of believing that you're always going to be safe. And there's a lot about the markets, I think, without getting too wonky, in my experience, which has been almost 30 years now in the markets, sadly, the markets are a market of stocks rather than a stock market. We used to look at things like Benjamin Graham, financial statements and balance sheets and good valuation. But I think the markets are more driven and more centralized now. I don't think free price discovery is really the key. The markets tend to go up when the Fed or the central banks are dovish, when they're printing money or keeping rates low. And the markets tend to hiccup when the Fed is tightening the balance sheet or raising rates. In other words, the Fed has become the thermostat in a way, And that's a very dangerous way to look at markets this overvalued. I mean, yields very do matter. When yields go up or when rates go up, the markets tend to go down. We saw that really from March of 2022 until June of 2023. Powell's at the Fed, higher for longer. We saw the worst stock and bond correlated performance since the 1870s. So that was when the Fed was trying to raise rates to fight inflation, which they failed to do. But that more hawkish policy out of a central bank sent markets down. As soon as there's talk of rate cuts or more QE, markets tend to think that's a lower cost of debt. That's a tailwind for the markets, and they go up. So all ships go up and down on a rising or lowering tide, and the tide is really determined, sadly, by the Fed. The problem with that, where a central bank really centralizingly controlling the risk asset markets, the problem with that is at some point the Fed or the central bank can't control forever. And the question is, how long can this continue? How long can a central bank effectively support an S&P or support a risk asset market? And I think at some point the arrogance of the Fed that they can control the bond market through, again, like a thermostat with rates up or down or balance sheet expansion, tighter or loose, at some point the bond market has more power than a central bank. And at some point, there's a sell-off in bonds that the Fed can't monetize. At some point, there isn't enough money to print to keep yields from spiking and the cost of debt from just becoming too expensive for the markets and for the country itself. Determining when that happens is very difficult. You have to be cautious. I think, my mentor and investors that I went to when I was investing in hedge funds, guys like Jeremy Grantham, have done what we call bubble studies. And these bubble studies, I think, are forgotten right now because, Jeremy was looking at the Nifty 50 in the 70s, the Nikkei in 89, the dot-com, and of course the great financial. You look at all these bubbles from 2008 back to 97, back to 72. Higher multiples often precede really bad times. And the current stock market today is the highest market valuation in U.S. history. To me, that's not a good sign. That's a scary sign. Again, we saw this in 1929, 1972, 2000, 2007, these great big peaks just before the big sell-off. And people will say, yeah, but everyone's been talking about this for years. The markets just keep going up. And that's true. And frankly, even at these market highs, they don't compare to anything like we saw during the Nikkei in 89, which was trading at 65 times earnings. So you could argue this bubble can go higher, and you could be right. The problem is no one really knows what will be the tipping point, the needle that pops this bubble. And I can talk about a few of them, but you're really you're tiptoeing through a minefield at these highs, and you can chase these highs and you can hope for the best. But history and math confirms what Bob Farrell always said is the most ignored kind of market force, and that's mean reversion. And if markets mean revert, again, we're talking about a major loss in these markets. And what Jeremy Grantham has taught me is that there are two things that investors typically make the mistake of, or they're tilted towards. And the first is the man is tilted toward preferring good news. They only want to see the good news. So when I talk about this is bubble territory or overvalued territory, no one wants to hear that because they're hoping for the best. And I understand that psychology. And the second big weakness and commonality of investors, which again is what Grantham said, is that there's really no interest in longer term thinking. I think people just want to look at the markets today and look at it tomorrow and yesterday and hope that the next 5 or 10 years will be like the last. And my warning to them, and I think the warning that Druckenmuller or Paul Tudor Jones or Grantham or anyone else, or Dalio certainly, so it's not just me as a gold bug guy, the warning is be careful because anything that gets this high could still go higher. But the downside risk at this point to me is far greater than the upside risk. And the notion that this market will be saved by a central bank and that every dip is a buy is only good until it isn't. And sadly, I can't tell your listeners what is the sign or what will crack these markets, what will you look at. But I could say from my own experience, the two things I would be looking at is really interest rates. If interest rates get too high, that makes the cost of debt too high. That tends to be very bad for markets. If we have a recession, like we did during the dot-com bubble, that was really, as Steve Eisman said, it was a recession that caused that market to crash. So if we have a recession, that could be a needle. So a recession or rising rates, and I would also say for the Magnificent Seven, the stocks that are holding this market up, if they lose their net income margins, in other words, they've been making so many investments in AI, and I would say top-heavy, poor investments in AI, overvalued investments, that if any of those Magnificent Seven start to mean revert, lose 30, 40, 50%, again, Amazon lost 90% in the dot-com bubble. It didn't mean it was a bad company. It was just overvalued. I think if you look at net income margins and they start going south, that would be a sign to get out of this market. I think if interest rates on the 10-year go above 5%, 6%, you'd get out of this market. I think when the government actually officially announces a recession, you want to get out of this market. And, when there's a big sell-off, markets go down a lot faster than they go up. So long-winded way of saying this is an extremely overvalued market. It's, in my opinion, heading towards a mean reversion. There are a number of needles pointed at this bubble. I think people forget as well that, we've had 22 bear markets since 1925. We spent about half of the time recovering from the pain of those markets, the next half enjoying the ride up. But the 1929 crash didn't recover until 1958. 1972, when I was just a baby, that market bubble crashed. During the oil crisis, it didn't recover until the mid-90s. The tech bubble that I benefited from incredibly in 2000 didn't recover until 2011. And the Nikkei, which crashed in 89 when I was still in high school, it took 30 years to recover. So when people see a bubble now and think it's going to be fine for the next 20 years, I would remind them of just these basic historical trends that if you get caught in a trough that the Fed or the central banks can't airbag back up, you could be looking at many, many years before you get those profits back. And depending on your risk level or your age, you got to ask yourself, can you afford a 30, 40, 50, 60, or 70% retracement in markets that isn't suddenly V-shaped recovery back up? Because again, I think investors have been lulled into thinking that any market can be recovered, and they've forgotten the lessons of 29, 72, 2000, 89, etc. I don't think there's any exception to this. I don't think this time is any different. I think this market looks a lot like the dot-com market that I traded in my 30s and 20s back in 2000. And, I think AI is extremely sexy and new technology, but so was the internet in 2000, so was automobiles, so were railroads, so was electricity. But they all become overbought and then they become oversold. I think we're enjoying the last hurrah right now of this meme in AI, which can take this market higher, but the risks, again, far outweigh the rewards right now.